Hello. Yes. Yes. Sorry for that. I hope all of you can hear me clearly now. We'll begin with the presentation. So before I start with how do you all go about actually paying taxes, let me ask you all one question. Yeah, I guess you all can see the presentation now. Yeah, great. So great. I'll first take you all through the flow of presentation so that you all know what to expect from this presentation before we move on. So the first thing, I'll just give a brief about what taxes are. A very short brief because I know most of you should be knowing about what taxes are. Then very quickly we'll also see how much taxes should you pay in this assessment here. What are the slabs and what bracket do you fall in. Uh, and then we move on to how do you start your planning. And finally to how do you choose from the various options that are available to save taxes. So let's move on quickly to the presentation. Before I start, let me take a quick poll. How many of you have actually started tax planning for this assessment here? That is 2014 and 15. You can see your answers to the chat window. So we have a quick assessment of how many of you all are there. Great. So around we have two responses saying that they have done, two or three responses saying that they have done. So I'm assuming the rest of you all have not done it. So we have a major audience that has not done it. So great, we'll just move ahead and we'll see when is a better time to start your tax planning as well so that you all know how you all go about it. To quote Benjamin Franklin, in this world nothing can be said to be certain except death and taxes. So taxes do form a inevitable part of our daily life, whether we like it or not. We directly or indirectly do end up paying taxes to the government. So what does tax mean? It is nothing but the fee that the government charges us on the services or goods that we use. And why do we pay tax? Basically, the government collects taxes so that it can create facilities for us by using that tax. So, in a way, we should not be actually all that grumpy about paying tax. Yes, definitely we should try to save as much as we can, but in the end, it is being put to our own use. And like I said, there are two types of taxes, direct and indirect. One is direct means the ones that we pay directly to the government, and income tax falls in one of this category. While indirect tax means there's a mediator who collects the tax for the government, and something can be like service tax or sales tax that you end up paying to the shop owners are kinds of indirect tax. So how much tax should you pay? Um, as you may be knowing, as a regular taxpayer, income tax slabs keep changing every year. So the income tax slab for the year for this assessment year or financial year 2013-14 is the same as last year. There are no changes being made. Basically, up to 2 lakhs for both male and female, there is no tax rate applicable. Between 2 to 5 lakhs, there is 10% rate. Between 5 to 10 lakhs, there is 20% rate. And above 10 lakhs, it's 30% tax bracket. Most of us will fall into this category of male, female up to 60 years of age. Then we have senior citizens which the category is from male, female from 60 to 80 years of age. And again, there's a slight difference of the first slab wherein the exemption is up to 2.5 lakhs, where there is no tax, and then later from 2.5 to 5 lakhs is 10%, and the rest remains the same as the previous one. 5 to 10 lakhs is the 20% bracket, and about 10 lakhs is the 30% bracket. And in the budget 2013, there was this new category introduced of very senior citizens, of citizens above 80 years of age, who can enjoy an exemption up to 5 lakhs. So if And from 5 to 10 lakhs, they are again the brackets remain the same of 20% and about 10 lakhs of 30%. So the major change being up to 5 lakhs, the exemption, they have the exemption, they are supposed to pay no taxes. So they can take maximum advantage of this. So I hope everyone is clear with this. This is just general information that we should know before we start planning our taxes so that we know what the taxable salary. Okay, so moving ahead, are you supposed to pay tax on all your income? So obviously the answer is no, and which is why this we've organized this webinar to make you aware of how you can save on taxes. So general formula applied is taxable income will be equal to your gross total income. Gross total income is nothing but income from all sources basically. If you own any property, rent, and you're getting some rental income from there, that or your business or maybe invest in shares, the capital gains from there. So together, club together, all this forms the gross total income, and this minus the deductions. Thank God for that. Will be your taxable income. So basically, uh, gross total income is something that you will come to know about from your Form 16. It's not much of a Form 16 will give you your salary details. So salary details from you can get the total taxable income from the salary. Plus to that you will have to add your income from other sources to derive at your gross total income. And finally you will you reduce the deductions from that to get your taxable income, and then you according to your tax bracket you will be taxed. You will have to pay taxes. So let's quickly move ahead and see what are the deductions available to us. So before we move on to the deductions, to the options available, uh, the process a little primer on the process of tax planning. One is that it should not be an activity in isolation. What we mean by this is, I'm sure all of you all, or if you all are into investing, you all would have taken your risk profiling. If you all have not done your risk profiling, I would advise you to do you to get your risk profiling done because it forms a very important part of your financial planning as a whole and not only your investment. So risk profiling does not mean that you only should be investing in the capital market. It is a must for your other investments as well. And why this is important is because even in tax planning, when you plan your deductions, it should be according to your risk profile. In the sense, when we as we move ahead, you will see the various options available in debt and equity as well. So, if you know your risk, you have to choose your options. How much you should invest in related instruments, and how much you should invest in the equity related instruments. And the other thing for those of you who have not started tax planning, I would say that you should start tax planning as soon as possible. In fact, tax planning is a process that should be done throughout the year. So that you don't have, what we see is most people struggle to do tax planning in the last quarter, mainly in the month of March. And you end up investing in the quickest option available or the quickest thing that comes. It should be started right. It should start right from April and move on to March in a systematic way so that you are not pressed for investment, and also you have a proper plan of where you are investing so that it is not only it does not only help in saving, it also helps you in uh, generating a good stream of income for your future. In the sense, it will be a very good investment for your future if you plan properly. So those of you who have not started tax planning, I advise that start tax planning as soon as possible. Options. Okay, so we will be going. I'll take you through all the options first, and then later on we will see in detail how the options pan out and what are the best avenues for you to invest in. So first listing all the options, a lot of ATCs which give you a maximum. So these are the main avenues of investment or expenditure that form. So which require a lot of thinking, and there are a lot of options that we will see later. But from all this, you can invest up to a maximum of 1 lakh. You can claim a deduction up to a maximum of 1 lakh by combining all these options. So we will see all these options and we will see how that 1 lakh is best distributed among these options for you. Then we have the next category of health and well-being, where you have a slew of Section 80Bs and 180U, wherein you have all the insurance bills, your treatments of your medicals, or your if you have a dependent, disabled dependent, then the deductions on those. So and otherwise, if there's a physically disabled associate, they have a special deduction for them as well. So again, we'll see in detail how what are the deductions and what are the caveats in this. Then we have a next stream on loan. So obviously, I'm sure most of us, all of us want to own a good house somewhere, and we end up buying or taking a home loan. So nothing wrong in that. But we should definitely do. We should definitely take advantage of the interest paid, and we'll show you what is the maximum amount of interest advantage that you can take from home loans. There's also deduction available on education loans, uh, which is on which there is no deduction, as you can see. Uh, and in fact, there was a new section introduced in this year's budget for giving you an additional deduction. So if you can, so we'll see how many of you can be eligible for that as well. And then finally, there's a category that that a lot of us do not explore, which is donations. Donations again are if you are a philanthropic person and you wish to donate to charitable institutions, you believe in charity, then this is a great opportunity for you to go and donate to several charitable institutions. You can also develop towards scientific projects or to political parties and claim deductions on these. And finally, there are some other categories that are there now. There was a section introduced for that helps you save on your saving bank accounts, which was not available till now. So that's a great thing. Then there was a new scheme introduced, which is RGSS, and which we'll talk about later. And obviously, there is something for paying. You have a deduction of paying rent if you have no home. For those of you who do not have a housing loan. So in short, these were the options available. These are all the options available under the Income Tax Act to a particular assessee in this particular assessment year. And we'll see each of these sections one by one and see which option suits you the best. So the first one, ATC, ATCC, and ATCCB, which is your slew of investment and expenditure options. Like I was telling you, you should bear in mind your risk profile, and that's why I have categorized the saving options into these streams of fixed income or debt, equity linked, and expenditure. So what you first need to decide before you decide on what options you choose from these is that what is your risk profile. If let's take the example of a balanced individual. So if you are a balanced individual and your equity and debt exposure is 50-50%. So and you can invest a maximum of up to 1 lakh into um, these three sections put together. So that becomes a 50,000 of investment into debt and then 50,000 investment into equity like. So let's see what are these schemes in general. I'll be talking about each one of these one by one, and then we'll uh, we'll see which one suits you the best. So let's first talk about PPF. PPF, I'm sure a lot of you would already know about PPF since it's a very well-known and old option. PPF is nothing but a fixed income pension, a public provident fund scheme introduced by the government of India, which the main thing is the it has a lock-in of 15 years, and the interest on this is linked to the interest rates in the market. So as of now, for this year, you will be getting an interest rate of 8.7% on PPF. According to me, this is one of the best schemes available for investment to us as an individual, since you can not only it's not only you can claim deduction of the amount invested into the PPF, but also the interest that you receive on on the PPF scheme year on year is exempt from tax. Plus the principal, the amount received on maturity is also tax. So it falls into a category of EEE, which is a very great option. So basically, you will not attract any more taxes once you invest in PPF. So this becomes one of the great options for investment. One the only the only what do you say the only pitfall of PPF is that there's a very high lock-in period of 15 years. That is the only disadvantage of PPF. The second disadvantage is obviously it is market linked, but then uh, the advantage of both these, you can also see this as an advantage that it becomes a sort of investment for your retirement planning. So you can invest, you can be rest assured of your investment. Uh, and in fact, there is also an option of partial withdrawal after 5 years. So after 5 years, there is you can withdraw partially from your PPF account if you need sources, or you can also take loan against the amount kept in your PPF account. So there are various options, various benefits for PPF, and I think a certain portion of your investment should definitely go into PPF. Uh, Coming to the next one, which is EPF or VPF, which is nothing but the Employee Provident Fund or the Voluntary Provident Fund. Now, Employee Provident Fund is available only to salaried individuals, and again, like PPF, the interest is into the market rate. And again, you cannot withdraw funds from EPF unless until retirement. Of course, there are certain if you're locked in until your retirement. Of course, you can withdraw it, but if you withdraw it, you will not be able to enjoy the tax exemption, or the you will not be given the entire interest amount. So EPF is, like I said, it is mandatory for all salaried individuals up to 12% of your basic salary plus your dearness allowance. Uh, you can what voluntary provident fund means is you can voluntarily opt for more investment. So you can make it to 100% your contribution into the employee provident fund. You can increase it to 100% of your basic allowance and your dearness allowance. Um, and that basically into EPF the contribution is also the 12% contribution is matched by the employer, but voluntary provident fund the employer will not match your contribution. It is only for your investment. Secondly, uh, the exemption available on EPF is only limited to um sorry. Yeah. Uh, yeah. So you can claim up to 100% of your deductions on EPF. Again, interest earned on EPF is tax free, so it's again a tax free income stream. And the loan you can again like PPF, you can also take loans in EPF. And uh, while there is a lock-in up to retirement, there are certain partial you can do a partial withdrawal, but there are certain conditions to it, like I told you. Um, the only caveat again being that interest rates are market related. So if the interest rates do fall in future, this might not seem as a very attractive investment, and your investment that you've already made into this will not earn as attractive returns as might other schemes. Uh, Having said that, a certain contribution does go into it mandatorily, so do keep that in mind that a certain portion of your 50,000, so for a balanced individual out of 50,000, a certain part of your salary will go into EPF contribution, and you can then invest the remaining amount into PPF for the others. The next one is national savings certificates. This is nothing but again a scheme by the government of India, wherein you have 5 year and 10 year 10 year. It's a fixed deposit scheme where you have 5 year and 10 year schemes by the government of India, and again the interest is market linked, and it ranges in between 8.5 currently you will be getting an 8.5% on 5 year and 8.8% on a 10 year scheme. Again, there is no maximum limit for investment in your national savings certificate, but it is restricted. The exemption is limited to 1 lakh rupees uh, by the section definition. So again, this is a good option for you. Uh, there is moving on to the next one, the senior citizen savings scheme. This is like the name suggests, it's available only to senior citizens. So 60 years and above, individuals 60 years and above can look into investing in this scheme. And the interest paid out is again 9.2% on from with effect from 2013. So for senior citizens, this is a very good option. If you fall into that bracket, you should definitely take advantage of this. Um, the minimum investment in this is 1,000, and your maximum investment can be up to 15 lakhs. But again, exemption can be claimed only up to 1 lakh. So the only disadvantage of this being that the interest that you will generate from senior citizen savings scheme is taxable, is further taxable according to your income tax bracket. And uh, the uh, the other thing is no partial withdrawal is available. Plus, there would be a TDS deduction on your senior citizen scheme if you have an interest of more than 10,000. We'll see where this 10,000 comes from later. But having said all that, it still remains a very good option for senior citizens. Uh, then I think we have 5-year tax saving fixed deposits. I don't need to talk a lot about that. It's like a normal fixed deposit. The only thing is that it differs is it's labeled as a tax saving deposit, and if again your interest payment falls more than 10,000, there'll be tax deducted at source, and you will have to do it through a eligible, through a certified bank. Um, Similarly, you have a 5-year post office time deposit, which is very old. Nothing all you have to do is you have to invest into the scheme. The disadvantage of both these schemes being that for 5 years your money is locked in. And finally, you have the NHB Suvrudhi bonds. Again, these are government bonds that will help you invest into invest like the interest rates are fixed, and you can invest them up to a certain limited period. So that again remains a good option. Now, on coming to what you should do, which option should you choose from this one? Like I told, one, EPF remains a mandatory contribution for salaried individuals. So if you are a salaried individual, a certain part of your income will definitely go to that. After that, the remaining part of your income you can split depending on your availability, on your requirement for money in the later period. So if you require money within, let's say, for a house or for your child's education or marriage, or let's say for a car, in within the next 4 5 years, then you should opt for a smaller period schemes such as the 5-year tax saving FD, or your 5-year national savings certificate, or your 5-year post office time deposit. A better option obviously being 5-year FDs or 5-year national savings certificate. And if you're a senior citizen, you should definitely go for a senior citizen savings. And if you are not limited by any such requirement, and if you will not require, you will not require the funds for long, or if you know you can arrange those funds from somewhere else and you want to plan for your retirement, PPF, like I said, remains a very great option. And even if you require the money, uh, do require the money for after a certain period of time, you should ensure that you invest at least a certain part of your allocation to PPF, as it becomes a great investment for the future. Coming to the equity linked schemes. So equity linked schemes, there are like I've shown here, there are 5 options. We've seen detail in about one or two, and about the remaining I'll tell you in brief. ELSS is equity linked savings scheme, which is available, has been available to individuals for a long time now. What it basically means is you there are mutual funds that help you invest in the scheme. There are mutual funds that help you save taxes through ELSS. But basically, you can invest into these mutual funds and you can earn a tax deduction from these. The only caveat being that your tax exemption, your money will be locked in for 3 years in the case of ELSS, and obviously your returns will be linked to the market, to the equity market. So it becomes a slightly risky option. Uh, but that being said, all equity linked schemes will have a certain risk options linked to them. But that being the whole point. That is the whole point of taking your risk allocation, your risk profile into consideration. Since you've determined your risk profile and you know that you can take a certain exposure to equity, you should go ahead uh, and invest in equity linked schemes. What you can alternatively do is if you invest on your own into equity markets, you can then skip these options and move to the fixed income options entirely, and you can invest the entire 1 lakh for tax purposes in fixed income brackets and invest the your equity linked allocation on your own separately. What basically you need to keep in mind is your entire allocation of your investments, not only for tax purposes, but your entire allocation that you or your entire investments that you do is follows your risk profile appetite. Uh, that being said, coming back to ELSS, the gains on ELSS are again tax free, and the advantage again is that it will help you beat inflation if the um, uh, equity markets perform. So in fact, it is the only option that will help you beat inflation from this, and national pension scheme is another option that will help you beat inflation here. So these two options help you beat inflation and earn lifetime returns. But like I said, the disadvantage being that the returns are dependent on the stock market. So nonetheless, you can still go ahead and invest in this. Then you have pension funds. Pension funds are nothing but these are again schemes that help you invest for your retirement or for your pension after your retirement. Uh, there are various schemes by life insurance, by insurance providers or by banks these days, but the returns on these pension funds is extremely low, has been extremely low and does not make sense for you to invest in these pension funds. So as far as I would advise you to stay away from these pension funds because they do not help you in long-term wealth creation. In, uh, Instead of investing in pension funds, you would rather invest in ELSS or your national pension scheme, or you can put it into your fixed income rather, but stay away from pension funds is what I would say, because the return that is generated by these pension funds ranges in between 1 to 2%, so it makes absolutely no sense in investing in pension funds. And finally, there is ULIPs. I think if you all must have read online, or you all must have, if there is anyone of you who is generally aware of ULIPs, we know that these products are absolute no-no for investors, as again the returns by these have been very paltry, and instead of investing in ULIPs, you'd rather invest in term insurance and invest um, in the into a term insurance separately and equity separately. So ULIPs definitely is again a no-no. We'll see into detail in life insurance and national pension scheme. So moving on to life insurance, again life insurance is uh, should not be seen as a tax saving option. You should not do life insurance for the purpose of tax saving, is what it means. You should do life insurance only if you require a life insurance. That is only if you have dependents and to save tax. So definitely it is not. It is something that is incidental. It is an incidental tax saving. It is not a purposeful tax saving. So if you have dependents and if you have bought a life insurance, then you can claim tax deduction up to it. It should be the process you follow and not the other way around, that okay, I have to save tax, so I should invest in a life insurance, and that's why let me go and buy some life insurance. That should not be your approach to life insurance, because there are a lot of other avenues to invest in. Uh, so life insurance, don't look at life insurance as an saving tax option. Secondly, if you buy life insurance, go for a term plan only because that is the best, that gives you the best coverage for life insurance. Do not mix it with other schemes like endowment or ULIPs because uh, term plans will give you better returns. Endowments, for if you want to invest in endowments, you would rather invest in PPF and term plan. That will give you a better return than you going for an endowment. Since this is not an insurance thing, I will not go into details on what an endowment plan. But yeah, do remember that that the best option for a life insurance is a term plan, and you should only stick to that. And like I said, instead of buying ULIPs, you'd rather buy certain very good performing returns, good performing, high return giving mutual funds, and term plans separately rather than going in for ULIPs. Now, again, some other pointers for you all is all can those of you all who are net savvy can buy life insurance online because they are cheaper. They do not involve your agent commission and all. So they come cheaper. So you can do your research online and buy it online. Plus, general rule is that the sum assured should be at least 10 times the annual premium that you pay. This can be increased to 15 times the annual premium if there's a disability. But generally, this is the rule that is followed. So look out for these things when you buy a life insurance. The next is National Pension Scheme. Now, National Pension Scheme is a scheme that is not widely known to investors. It was introduced 2 to 3 years back, and it has not gained a lot of popularity among investors for two reasons mainly. One being that even on maturity, you cannot withdraw the whole amount. Only 60% amount is what you can withdraw, and 40% you have to compulsorily buy an annuity. The second thing being that again it is an equity linked scheme, so your performance will be linked to market. But that being said, again it remains a very good option for investment for your future. So you should look at it into by way of an investment option rather than only as a tax saving option, and it is in fact a very great option for investments, and you should look at investing again certain at least a certain portion of your amount in a national pension. So just to give you some details about National Pension Scheme, National Pension Scheme has two options, two accounts, Tier 1 and Tier 2. Tier 1 is the compulsory account and Tier 2 is optional. Under Tier 1, and only contribution under Tier 1 is eligible for your tax deduction. So anything that you invest in Tier 2 will not be eligible for tax deduction. Again, there's a minimum requirement in Tier 1. A minimum annual of 6,000 is required for in Tier 1, and every transaction has to be a minimum of 500. You cannot invest below 500 in a national pension scheme. So uh, the deduction that you can claim is restricted to limited to 10% of your salary. So uh, it comprises of your basic and your dearness allowance again. So so amount that you invest in Tier 1 will be eligible for tax deduction. Anything over and above that will not be eligible for tax deduction in Tier 2. So again, the caveat in Tier 1 is, like I told you, uh, you can withdraw a maximum of 60% at maturity, and you have to compulsorily buy annuity for a minimum of 40% of it. So that is one of the disadvantages of NPS. But for those of you who will anyways do buy insurance and are sure that you will end up buying an annuity later on, which is again a great plan, you can definitely look at investing in NPS. What you can otherwise do is to restrict yourself from uh, yeah what you can do is you can invest the minimum amount of 6,000 in your Tier 1. If that fulfills your 10% of your salary exemption limit, you can just invest in Tier 1 and then invest the remaining amount in Tier 2 so that the maturity, the 60% withdrawal limit does not apply. The other disadvantage is that the amount in NPS is locked in till you are 60 years of age. Um, yeah, and your, I am sorry for this incomplete thing, which comprises of basic plus DA. It's this basic plus your DA. So salaried employees 10% of your salary, which comprises of basic and DA. Okay, I hope that's clear now. And there is an additional advantage in NPS is you can claim an additional deduction over and above the 1 lakh available under these three sections. Yes, so the additional deduction in fact is up to 50,000. You can claim up to 50,000 additional deduction under ATCC2. Uh, the only caveat being that deduction this deduction, you'll have to convince your employer to start NPS scheme through the company. So what this requires is basically that your employer starts an NPS, registers for an NPS scheme, and they directly deduct your salary and invest it towards NPS. Only then can you claim an additional deduction. So if you can convince your employer, in fact, I think Wipro has done it already, and if a lot of you can gather a lot of supporters, and if you can get this your employer to do this, it will be a great additional saving for you and for all the employees in your office, in fact. So you can definitely look at getting this done in your office. So coming to what schemes are good for you, like I said, it picks in PPF and PPF. EPF is mandatorily available, and you can further look at investing further into EPF schemes. PPF remains a very good option, and a certain allocation should go into PPF. If you are looking at a shorter duration, then you can look at bank saving FDs. In equity linked schemes, you can definitely look at National Pension Scheme and ELSS as your option. Uh, Pension fund ULIPs are definite no-nos. You should never venture there. Life insurance premium it should be incidental. If you have a life insurance premium, you can claim deduction up to that. But if you do not have a if you do not have a if you do not require a life insurance, do not buy a life insurance just for the purpose of saving a tax. Okay, finally, let's come to the third category of expenditure. Again, all these are incidental tax saving available to an individual. So, if you have bought a home, if you have got a house and you've taken a home loan for the same, your principal repayment on that home loan will basically classify for tax exemption. Then again, if you're buying a house and you pay a stamp duty or registration cost of the house, that amount is available to you as a deduction. This deduction will be available only if it is done in that particular year. So if you're paying a stamp duty or registration in 2013, you can claim a deduction up to that amount in 2013 itself. And again, it should be the amount should be paid from your own funds, and it should be the house should be in your name. So this is definitely two or three conditions that will have to be met. Apart from that, then there is tuition fees. Tuition fees you can claim for 2 children max. Again, the maximum deduction for this is 1 lakh, so it falls under the 1 lakh thing. All these so all these, if you have already claimed, uh, so if you have, you already have a home loan and you are repaying a principal, or you bought a home house and you have certain registration costs and stamp duty, or you have children for whom you are paying tuition fees, so deduct that much amount from 1 lakh, and then the remaining amount you need to invest it into fixed income or equity linked schemes as your risk profile may suggest. For tuition fees again, there is a a maximum of 800 per child. So you can claim for 2 children, you can claim a maximum of 1,500 per month of fees available for tuition towards tuition fee. You can deduct it. So that's pretty much on towards section 80 C, 80 CCD, and 80 CC. So I hope this is clear to you. This forms a major part of your investments towards tax, and I think this takes a lot of time for deciding. The other exemptions that over and above this, there are other deductions available that we will be going through, but those are pretty much again, like I said, incidental uh, or if you fall in those categories, applicable only if you fall in categories. ATC and ATCC, CCD are something that is applicable to all of us, and we should try to take the maximum benefit out of this. So make sure you invest you invest the entire 1 lakh towards these sections and claim the maximum tax you can, claim maximum tax that you can. Okay, so moving ahead, you have with the, let's go to the next, our next section, which was related to healthcare. The first is medical insurance. So again, this is something that is available to all of us, and again, you should try to take maximum advantage of this medical of the medical insurance scheme available. So under medical insurance, the maximum deduction available to individuals is up to 15,000 below 60 years of age. So if you're below 60 years, you can claim a deduction of up to maximum of up to 15,000. And if you're above 60 years of age, you can, this deduction is increased to up to 20,000. Again, so basically, senior citizens can claim up to 20,000. And your 15,000 reduction includes a preventive health checkup cost of up to 5,000. So this was introduced in, this is additional thing introduced in budget 2013. So now if you, for those of you who do get up health checkups every year, you can claim that amount in under your medical insurance up to a minimum 5,000. And this is not only your medical your health checkup. You can also include the health checkup of dependents. So dependents include your spouse, your children, your parents. So basically all of this, but a total of up to 5,000, and this will definitely come into the deduction of this, into this maximum limit of 15,000. And in case if your parents are senior citizens and you do a preventive health checkup of that, you can claim it up to a maximum of 20,000. So, so here you have a maximum. You this is you can claim a maximum of up to 35,000 in medical insurance if you have if you do a medical insurance for your parents. So 15,000 being for your self, spouse, dependents, your children, and if you have if your parents are senior citizens, you can claim again an additional reduction of up to 20,000 for them. Okay, so these so this is your self deduction and this is an additional deduction for your parents. So like I said, you can claim a total of 35K on this on your medical insurance. Um, and this 15,000 basically or your this 20,000 includes the preventive health checkup cost. Okay, moving on to the next section, ATDD or handicap dependence. Hopefully, a lot of us will not fall into this category, but for those of all who have handicap dependence, you can definitely claim expenditures incurred up to a maximum of 50,000 in case of, let's say, abilities or lesser conditions. Towards tax deduction. So expenditure income basically includes any training for the handicapped or any treatment or any development or any any development expenditures can be included in under this. So maximum of 50,000 for lesser severe for less normal conditions, normal disabilities, and for severe conditions the limit is 60. The limit is increased to 1 lakh. What is meant by severe condition is 80% and above disability. So 40% and below disability will be 40% to 80% disability will classify for a normal reduction of 50,000, and 80% and above disability will classify for a 1 lakh deduction. Okay, like I said, dependents can be anybody, parents, spouse, children, or siblings. Uh, so only caveat being the dependent should not have claimed deduction for self. So if the dependent claims deduction for self, then you cannot reclaim it under your tax rate. Okay, and like I said, it can be anything: treatment, training, insurance, anything. Okay, the next is treatment of certain diseases for self. Again, self or dependent again. Now, these certain diseases are the reduction available are up to 40,000 for below 60 years, and for senior citizens, it's a maximum of up to 60,000. It can be self or dependent. Dependent, the only caveat being that they have to be wholly dependent on you, that is, no income stream of their own. Uh, Again, so the certain diseases are defined by the Income Tax Act, or certain very severe diseases like cancer, AIDS, certain neurological diseases, so with severe disability up to 80% fall under these categories. So if you're having any such severe we'll let you know the list later. And you can check if you fall under that, you can claim reduction. Moving on to our next category, if the taxi themselves is physically disabled, you can claim an additional deduction under 80U. So apart from the treatment, so basically uh, under 80 DDB, where you could claim reduction for treatment, you can claim an additional reduction in 80U for your disability. So up to 50,000 or more, you can claim for normal disability, which is between 40,000 and more. And for severe disability, which is 80% or more, you can claim up to 1 lakh of amount for towards your tax deduction. Okay. Then moving on to our next section. So this was healthcare. Now we have next section of loans, uh, wherein all we see about what kind of loans categorized for deductions under these categories. So if you have taken an education loan for your higher studies, uh, here's good news for you. The entire interest that you pay is deduct eligible for deduction. There is no limit for this deduction. The only caveat being that you can claim this deduction for a maximum of 8 years. So starting from the period you pay the interest. So if you start paying interest from 2013, from 2013 you can claim a deduction up to 8 years on the interest that you pay towards the education loan. And like in case of home loans where principal repayment was eligible for tax deduction, principal repayment in education loans is not available for tax deduction. So that is the caveat here. You will not be able to pay the tax deduction on the principal repay. Nonetheless, it remains a good opportunity for those of you who have taken education loans for higher studies. Again, what you need to remember is, and I think everybody knows that these are incidental tax saving. Nobody will go and actually take a loan to save tax. So that is more thing. Again, education loan can be for anybody, can be for self, can be for your spouse, or can even be for your children. So you can claim the income deduction for education loan paid for all of these, for the higher studies for any of these dependents or self. Then let's move on to interest on home loan. So there is a deduction of up to 1.5 lakh available under section 24 for if you have a self-rented house. So basically what this means is if you have just taken bought one house and you have taken one home loan, you can qualify for a reduction of up to 1.5 lakh on the interest amount paid. The interest repayment that we saw for the home loans falls under the ATC category and it comes under the 1 lakh thing. So that is not to be mixed with the interest paid. This deduction is specifically available on the interest for the home loan, which is up to 1.5 lakh. Uh, in case of multiple houses, there is no limit on deduction. So if you have more than one house loan, you can claim the entire amount of interest paid towards your deduction of your tax. Okay. Again, the caveat is the deduction is available only from the year of possession or completion of the house, or from when you uh, get the possession of the house. Only from then will you be able to claim the deduction. And the second thing is your income minus expense under as defined under section 24 should be negative. What I mean by this is basically income under section 24 is any income that you get on your rented house, that is your income. Your expense is any interest that you pay towards your house loan is your expense. So basically, if you earn less from your interest and you are paying more towards interest, then you can claim this deduction. But if you are earning rental income and all your interest income is covered under that, you will be eligible for interest income. So basically, this should be negative. This was deduction under 24. For those of you who have a house loan for taking a house loan in 2013, there's a good news for you. There was an additional section 80EE introduced on interest on home loan in budget 2013, where you can claim a deduction over and above that 1.5 lakh of 1 lakh under 80E. The only caveat being that you have to loan has to be taken in this financial year 13-14, that is between 1st April 2013 to 31st March 2014, you have to take the loan, plus your amount should not exceed 25 lakhs, and the cost of your house should not exceed 40 lakhs. So these are 2 or 3 conditions that you have to meet. If you meet these conditions, then you can claim an additional 1 lakh rupees under Section 80. So you can claim a maximum of up to 2.5 lakhs on the interest paid towards house loan if you have taken an interest housing loan in this particular year. One another thing is that if you do not claim the entire limit of 1 lakh, uh, one towards your ATE, you can extend these uh, extend this uh, extend these this deduction towards the next year. So suppose you claim up to a 50,000 of deduction under Section 80 in 2013-14, you can claim the remaining 50,000 in 14-15. But like I said, the loan should be taken in the financial year 13-14. So that's on interest. That was on housing loans. Moving on to our next section, there were some uh, other uh, other sections apart from these available to you for tax deduction. One of them being house rent. Uh, House rent, basically, if you do not receive an HRA allowance into your in your salary structure. I will take you to a salary structure later and how you can save tax there. But basically, if you have a very simple salary structure and your company does not give you a house rent allowance, you can claim, and you're paying in house rent, you can claim deduction in house rent. So the house rent deduction is basically the lower of these three numbers, 2000, either it is 2000 per month, so that will be 24,000 for a year, or 25% of your annual income, or the rent paid up to 10% of your annual income, whichever is lower of the three numbers will be deducted towards your HRA, towards your house rent allowance under Section 80GG, and that much you can claim a tax deduction up to that amount. Uh, the next separate avenue for tax saving is RGESS. Now, this is not something that is applicable to all of us taxpayers. It is available only to first-time investors. Now, what is meant by first-time investors is that you are opening a demat account for the first time. Basically, that means you do not have a demat account up till now, and you are opening a demat account in this year. You're new to the capital markets, basically. So that will qualify you for RGSS. Again, RGSS has a maximum deduction of 25,000, for which you will have to invest 50,000. So basically, the deduction is 50% of your investment, and the maximum investment allowed is 50,000. That means the maximum deduction allowed is 25,000, and you can claim this deduction for a consecutive of 3 years from the time you open your demat account. All you have to do is while opening your demat account, you have to fill up a relevant form saying that you are eligible for RGSS, and you will be able to claim deduction under RGSS. Basically, this will be tracked through your demat account and your PAN number. Okay, so RGSS again is an equity linked. What it is a Rajiv Gandhi equity linked savings scheme. So basically, through RGSS, you can invest in the equity markets directly. You can invest a maximum amount of 50,000 in equities directly, but it should only be in CNX 100 or BSE 100 stocks. And you can also invest in certain mutual fund and ETF schemes that are eligible for RGSS deduction. So, like I said, this is the first time for first time investors. So, if you do not have a demat account, you can open a demat account and start investing in equity markets and claim a reduction under RGSS for 3 years. Okay. Then another additional deduction that is available to us taxpayers from this budget 2013 is interest on saving account, which is a good thing for us. Under this, a maximum deduction of 10,000 on interest earned on the saving bank account is eligible for tax deduction. So a lot of us have money available in our saving account, money lying on our saving account, and we keep earning interest in that. So if your so you will earlier this was taxable income,
and you would have to pay tax on this. So now you can claim a reduction of up to 10,000. So basically, if you earn an interest less than 10,000, you will not have to pay any tax on your saving account income. So that's good news for investors, and more money saving avenues for you. Apart from this, we have another section of donations that we had seen. A lot of us might not be, may or may not be interested in this. So I'll take you through this quickly. ATG, there are different types of donations. ATG is basically charitable organizations. ATGGC is political, and ATGGA is to scientific for scientific research to any scientific firm or a university. So basically, deduction under ATG and ATGGC is 100% deduction, up to limited up to 10% of your gross annual income. So if you remember, I told you earlier, your gross annual income includes your income from salary plus your business plus your property plus any other capital gains and plus any other sources that you might be getting income from. So 10 limited to up to 10% of that gross annual income is the limit up to which you can claim for charitable organizations and political parties. Again, the charitable organizations, the government has specified a list of charitable organizations, and only if you invest in those charitable organizations can you claim a deduction. So make sure you are aware of this list before you invest in those. Political parties, you can donate to any political parties, and donations for scientific research to any university or to any scientific institute is available for 100% tax deduction. So the amount 100% amount deducted is available for tax deduction. So those of you interested in making donations can take advantage of that into paying in claiming your tax deduction amount. So that was the major sections available for tax deductions. Apart from this, we have certain um, other avenues open to us that we can take advantage of to save tax. And one of this is parents or using our parents, senior citizens or our parents or major child as assets for tax planning. Basically, if your parents are not earning any income, you can save tax through them. Let's see how. One is you can invest surplus money up to 25 lakhs in each of your parents' name. Let me give you an example on how you can save tax with your parents. So suppose you invest up to, let's say you're investing up to 25 lakhs in each of your parents' names. So that's a maximum of 50 lakhs of investment uh, that you do in your parents' name, or you do it in your name. So you invest a 50 lakh into your name under FDs or any such thing. The interest earned at, let's say, 10% tax rate, which is the normal tax fixed income, fixed deposit tax rate available now, will be 5 lakh. So if you earn an income of 5 lakh, for your parents the tax liability will be zero, as they have as they have no tax. They have above 60 years, so they can claim a deduction of up to 2.5 lakhs. So 2.5 lakhs each parent can claim a reduction. So 5 lakhs, the tax liability will be zero. Whereas for you, if you invested it in your own name and earned an interest of 50 or 5 lakh, the interest, if you fall in the 30% bracket, will be 1.5 lakh. So the tax saved is whooping 1.5 lakh in taxes if you invested in your parents' name. So basically, this is only again obviously this is only if you have surplus money available, and you rather than investing in your own name, you can invest it in your parents name and earn a and save taxes over there. So that is one thing you can do. The other thing that you can do towards parents or major child is you can keep your parents insured. Like I said, you can claim an additional deduction of up to 20,000 towards senior if your parents are senior citizens. So this will also help you take care of their expenses later, and it will also help you claiming saving in taxes. The other thing is you can pay even if you're living in your parents. Can the I told you earlier under section 24, you can claim deduction on the house rent paid. What you can do is legally get into. While many of us might laugh at this idea, but it's a great idea to saving taxes, that you can actually enter into legal agreements with your parents, and you should actually pay rent to your parents and claim deduction towards rent paid on this amount for saving taxes. So basically, it's a legal way of doing this. You can do this, and instead of the venturing elsewhere, you can just make use of this. All you need to do is enter into a legal agreement with your parents. The other thing you can do is you can share shares to your parents to offset loss. So if you are investing in capital market and you have made uh, loss on certain shares, you can sell these shares to parents in an offside in an of the market transaction. So basically, off the market buyers are not easy to find. So you can go and so you can make your parents as your off market buyers, and later on when you feel they are profitable enough to sell, you can sell it in your parents' name, and that will also not attract any income. And when you sell it off market income, the loss that you've incurred, the entire amount can be claimed towards saving taxes. So that's a very good opportunity for you to save taxes. Another way of saving your taxes is if you restructure your salary. Again, this is not available to all of us. So if you are basically working in a major conglomerate and they have a fixed salary structure, you cannot do anything. But where you can restructure your salary, you should do so. This is basically because there are certain parts of your salary that are fully taxable, and there are certain parts that are partially taxable, or they are free, absolutely free. So you should try and you should try and make your salary structure into these parts. So, like I said, there are certain fully taxable income where you cannot do anything, which includes your basic salary, your DA, your special allowance, your bonus, your overtime, your arrears, your personal pay, your food allowance, the furniture allowance, the shift allowance. All these are included in fully taxable income, and you will not be able to claim any tax deduction on these. But what you can do is you can ask your employers to introduce a medical allowance or a transport allowance of up to 800 per month. So this is basically a conveyance allowance, which is increased to 1600 per month for orthopedic person. Or you can do a leave travel allowance. You can include an vehicle maintenance allowance, a house rent allowance, uniform allowance if your employer does have a uniform code, only then this will be applicable, otherwise this will not be applicable. Then you can directly, instead of claiming child education, you can have a children education allowance, which is again maximum for up to two children, it's free. Then you can also include a newspaper journal allowance, which is you can claim an deduction up to a maximum amount of 12,000. And telephone, you can claim a telephone allowance. And though food allowance is fully taxable, you can insist on your company giving meal coupons like the Sodexo or tickets that are available. And these are basically tax free, in fact. So if you restructure your salary, your taxable income itself will come down, and then you can go and uh, save, or you can go and claim deductions on over and above that. So basically, these are the entire avenues that are available to you as a taxpayer in India for the year 2013-14. Um, so if you all have any queries, I think we would have received certain queries on the tax on the Q&A section already, and we'll take that first. In addition, if you all have any queries, you can Yeah. So, hello, can you all hear me there? Yeah. Sorry for that loss of voice over there. I'm sorry for the disturbance. Yeah. So we had a first question from Jitendra who's asking. One second. Just let me go to the questions here. Uh, yeah. Sorry. It's by Nirmal Bansali in section 80G. How to know whether the reduction is for 50% or 100%? In section 80G, well, I think you messed up the section, sir. Under SETI is for donations to charitable institutions, which is basically up to maximum up to 40,000, deductions available up to 40,000 of your donation, or 10% of your annual income, whichever is lower. So that there is no question of 50 or 100%. Your question, I'll be happy to read, the answer it. Mm, Moving down. Yeah, Mr. Ashok Desai is asking how many renewals on PPF is allowed. Sir, after you have completed your 15 years of block, you can again renew it for 5 years block for a consecutive, for you can again renew it for once for a 5 year block, and after that you have to renew, you will have to open a new account. So it's a maximum of 20 years allowed on PPF. I hope that answers your question. Then. Sagar Prasad says that he thinks NSE is not a 5 year instrument. Well, NSE was earlier a 6 year instrument, but from 2013, they have reduced the slab to 5 year and 10 years. So you do have an NSE option available for 5 years. So if you are interested in investing in that, you can take advantage. Uh, Nirmal Bhansali is asking what are the deductions permissible for income tax for business, from business or profession for filing ITR for. So basically, so what happens is the income from your business is clubbed into your gross total income, and those as an individual you can then claim only these income, these deductions on your total salary. So apart over and above this, this is the same deduction that will be applicable to you on your business income as well. So basically, your income from your business is clubbed with your other normal income, and then the deductions are applicable. Uh, Ashok Desai says NPS is good for young as it provides many creative window of saving tax along the working life. Could you elaborate on this aspect, please? Yes, sir. Like I said, I have already elaborated on NPS, but to again give you an idea, NPS basically has two accounts, Tier 1 and Tier 2. Tier 1 account is a compulsory account and it requires a minimum investment of up to 6,000 and per year, and every transaction has to be a minimum of 500 rupees. You cannot do a transaction of less than 500 rupees. And also only investments made into Tier 1 will be eligible for your tax deduction. You can also invest in Tier 2 accounts, but that will not be eligible for income for tax deduction. Um, so under Tier 1, the again the one disadvantage remains that on maturity, you can withdraw. There is a lock-in period. Firstly, there is a lock-in period of up to 60 years or retirement, or up to your retirement. And after that, also you will be able to withdraw only 60% of your investment. 40% of your investment into NPS will have to be used towards buying an annuity, and will not be available for you to use as per your scheme. Okay, so I think that's all I can say. That's all you need to know. If you need to know a lot in detail, we have a blog on National Pension Scheme, which I can mail you the links later, and you can go through it in detail. If you have any other questions on how you should open the account, or how you can write to us, and we'll be happy to help you. One thing you need to remember in NPS is there are different schemes available for NPS, wherein you can choose from the amount of the equity and debt exposure that is available to you. So there are A, B, C, D, and E schemes, wherein the exposure of equity increases in each level. So basically, A being the in scheme A, you can opt for maximum exposure to debt and minimum of exposure to equity. So what you can do is you can start with a scheme which has maximum exposure to. If you're young, you can start with the maximum exposure to equity, and you can go on reducing your exposure to equity as you go ahead in life. So that is one of the things you can take into consideration. Other thing while you invest into NPS that you can take into consideration is there are 5 or 6 approved fund managers for NPS through the government. You can compare their returns that they have had for the year, and then you can choose your fund manager accordingly. Another thing is you can also change a fund manager mid-year. If you wish to change a fund manager, that option is also available. You can just go and tell your account your account holder that you need to change your fund manager, and you need to submit a form in requesting the same, and you can change your fund manager as well. So there is no restriction on that. Sankar Prasad asks a question: giving donation for children's studies includes in tuition fees. Well, donations of you cannot give to donations to universities. If you mean donations to universities, sir, then no, that does not include tuition fees. So tuition fees basically means tuition fees that you pay towards your children. So if you have, you can pay if you for your expenditure towards your school expenditure or your college expenditure on your own children of maximum up to 2 children can be deducted claimed under tuition fees, whereas donation to universities is a entire separate section where you can claim um, a deduction of up to 1 lakh. Paying medical insurance premium, Mr. Shankar Prasad asked us, paying medical insurance premium through credit card purchase is eligible to for deduction, paying EMI for 1 year. So medical insurance premium through credit card. Uh, yes, yes, this is eligible for deduction under your income tax. Basically, you will have to submit proof of your medical insurance. So, irrespective of how you pay it, it will be available for deduction, subject to a maximum limit of 15,000. Um, somebody is asking to explain, Shankar Prasad again is asking to explain leave travel allowance. Well, travel allowance is basically you can claim a travel allowance for 2 domestic trips in a block of 4 years under your to your employer. So basically, you will need to submit your proofs of your travel to your employer, and you can claim the so basically international trip does not classify does not under leave travel allowance any of your domestic trip can classify in leave travel allowance, and this can be claimed only once in a block of 4 years. Mr. Suresh, you is asking which is the best way to maximum reduce tax. Well, so like I told you, there are different sections available, and you can take advantages of all these sections. You need to see your eligibility for all these sections, and if you're eligible for these sections, you should not miss any of these sections. Like under ATC, you should claim a maximum of 1 lakh. Then you have under 80G, you have under 80D, you have medical insurance and health insurance. You should make maximum use of that. So certain things are under your are definitely under your control. So ATC you can claim up to 1 lakh. Then 80D you can claim 15,000 for yourself plus 20,000 for your parents. So see if they're senior citizens, then you should definitely claim this if you have that. Um, then again, the others are incidental. So these are only if you do fall into these categories, you will be able to claim these deductions, or you will not fall under these deductions. Again, loans are something that are incidental. If you have loans, you will be able to claim this. Otherwise, you will not be able to claim deductions. And donations depends um, on your will, on your philanthropic will. And again, house rent house rent allowance is something that you can definitely take advantage of. If you are not paying house rent and you're living in your parents' house, you can enter into an agreement, like I said, or some other certain other things that you can do, like I've mentioned in the later part, is um, uh, do is sell your shares that are loss making to your parents and claim deduction up to that amount, or you can restructure your salary. So what you need to see, sir, is what is your eligibility to all these sections, and wherever you are eligible, you should definitely make maximum use of it and not lose any opportunity towards. I think that's the maximum. That's all the questions that we have. Um, that brings us to the end of this webinar today. Thank you for attending this webinar with us today. I hope it was useful to you. You can also go through our blog, Stock Shastra, which is online blog, which is called Stock Shastra, to stockshastra@moneyworksforme.com, and you will find a lot of um, uh, these investment avenues explained individually. In fact, we are starting a series of blogs starting next week on tax planning. So you can register at stockshastra.moneyworksforme.com and avail read through these blogs to help you know about the various tax planning avenues in detail. Additionally, we will also be mailing you the presentation and recording for this webinar, and you can also go to this to learn about the various avenues available to you. Thank you so much for attending our webinar today. Uh, till you can We keep conducting these webinars every month for registered users, and you can take advantage of these to know about various investment topics. So till then, happy investing to all of you.